Welcome back to Project Pulse. In a previous lesson, we looked at a fully merchant case with a revenue put option, and then stress tested lender protection with case 17, where we turned on a cash sweep starting in year 6. On the dashboard, the key takeaway from case 17 is simple. The sweep helps us understand how quickly lenders get their money back if there's no refinancing after the 5-year mini-perm maturity. In other words, what does the downside path look like for the lender if the market shuts and we have to de-risk through accelerated deleveraging? Now let's switch to case 18. Case 18 is different. This is a structure where we start with a 10-year tolling agreement, stable, contracted cash flows, and then we roll into a merchant tail once the tolling agreement expires. Notice how the dashboard reflects this two-phase idea. The financing can be sized more confidently during the contracted period, but lenders still care about what happens after the CTA ends, because here that is sized over 15 years, meaning we effectively have a 5-year merchant tail. If you're new to this Deal Lab series, I recommend starting with part 1, where you can download the model start file for free and build the model alongside me. Link is in the video description below. Now, let's jump to the information memorandum so we're crystal clear on what we are modeling and why. For monetization pillar 3, transition and hybrid structures, we are looking at a 2-hour battery. The project earns a tolling price of $10 per kilowatt month, and that toll escalates at 2% inflation per year. The CTA lasts 10 years from COD, and during the CTA period, the full capacity is contracted. So from a lender perspective, we begin with stable, contracted cash flows. And once the CTA expires, the project transitions into a merchant setup. 60% of capacity is allocated to merchant energy arbitrage, and the remaining 40% is allocated to merchant auxiliary services. Since we are taking merchant exposure in the tail, lenders won't give us full credit for those merchant revenues. So in the debt base case or debt sizing case, we still apply a 20% merchant haircut, which is our conservative lender view. In this final lesson, we will also run 2 lender sensitivities. First, OpEx plus 20%. This checks cost resilience if operating costs come in higher than expected. And second, we are again asked to run a full cash sweep starting in year 6. This is the structural protection test. If we assume a 5-year mini-perm and there's no refinancing, and lenders push cash toward debt repayment starting in year 6, how much does that improve the lender's downside outcome, and how fast does principal come back? Alright guys, now let's move back to the model checkpoint file from our previous lesson. I've already flipped over to case 18, which reflects our hybrid structure of a full tolling agreement and a merchant tail, and I've already resized the debt in accordance with our updated sizing metrics. So let's flip over to our inputs time independent sheet and actually check out the final inputs for our final 4 cases. Right now we are in case 18, which assumes a 2-hour battery, unlike the 1-hour battery in our previous lesson. We have installed DC energy at beginning of life of 530, and the battery degradation assumes a curve considering that we start with a 10-year tolling agreement and then transition into a merchant setup. Let's scroll down further. And from a revenue assumption standpoint, you will notice that our capacity tolling agreement is turned on, as well as our merchant energy arbitrage and auxiliary services. We do not assume a revenue put option anymore, since the first 10 years we are fully covered by a capacity tolling agreement. So that capacity tolling agreement lasts for 10 years at a price of $10 per kilowatt AC month, and we have 100% of our capacity contracted. Let's scroll down further, and here you can see that our merchant assumptions starts 10 years after COD. So both merchant revenues kick in exactly once the CTA expires. And out of our 200 megawatt AC at the point of interconnection, we will have 120 allocated to merchant energy arbitrage. And the remainder, which is 40% or 80 megawatts AC, will be allocated to merchant auxiliary services. Let's scroll down further and let's check out first our augmentation schedule. You can see, since we are now again in a full tolling agreement, we do not have to augment the battery as much as in the full merchant case, because the degradation assumption will not be as aggressive as in a fully merchant case. So restoring 15% of buffer of the AC nameplate energy is more than sufficient to maintain the minimum point of interconnection capacity for 20 years. Then let's scroll over to our debt section, and you can see that again case 18 is our debt base case or debt sizing case, which means we will use that profile and copy and paste it for the other 3 cases. Here, lenders actually allow for a maximum leverage of 80%, and that will be mainly due to the 10-year tolling agreement and a maximum debt tenor of 15 years. Since we are also asked to run a 5-year cash sweep, or better a cash sweep after 5 years, in case 21, it is likely that lenders consider a 5-year mini-perm, which means they want to understand what happens if there's no refinancing after year 5, how quickly would cash sweep out the outstanding debt. And if that sweep occurs within the tolling agreement, then lenders can feel fairly confident from a structural standpoint. And last but not least, in our debt sizing case, we assume a 20% merchant haircut again. So let's hit the master macro one more time, just in case. Then let's move to the inputs time dependent sheet, and we will copy and paste the profile for case 18, copy this, and paste it for rows 160 to 162, which cover cases 19, 20, and 21. Paste that here, because that will be the debt repayment profile that we have determined in our debt sizing case and will apply for our equity base case and sensitivity cases. So first thing we will do is flip over to case 19, which is our equity base case, hit our master macro, and see how it shakes out from an equity standpoint. You can see nothing really happened in the first 10 years to our cash flow waterfall, but then there's an uplift from year 11 plus, and that is because we now do not consider a merchant haircut of 20%. Let's flip over to case 18 one more time to demonstrate this. Here you can see this is basically the lender assumption. Lenders are more conservative about merchant revenues, and from an equity standpoint, we are a little more confident, which means we still get a levered equity IRR above our hurdle at 10.64%. And these 10.64%, let's see how they compare in our scenarios output sheet. And you can see that 10.64% is slightly below our fully merchant equity base case, which was at 11.4%. But we cannot forget that case 19 is fundamentally underpinned by much more certain cash flows, because in the first 10 years, all of our cash flows are fully contracted. So also from an equity standpoint, although we get a lower return, we can be much more confident that this return will actually materialize, versus case 15, or better 16, which was our equity base case, where we had a revenue put option only partially covering a minimum floor of cash flows. Then let's move back over to the inputs time independent sheet, and we can run our final 2 sensitivities. Now for our first sensitivity, we will increase OpEx by 20%, and that sensitivity is allowed right here under our OpEx sensitivity, where we can essentially uplift all OpEx by 20, and we can do so individually for each line item. So that allows for maximum flexibility for sensitivity testing. So let's flip over to case 20. And we see that now we do apply a 20% uplift right here, hit the master macro, and let's actually see where this is flowing. And this is right here in our OpEx section in the operations sheet. we do now have an uplift of our OpEx after considering inflation of 20%, which means now we have OpEx of 142.8 million versus in a debt base case of only 119 million. So in a debt base case or debt sizing case, our levered equity IRR would be 8.45%, because here we assume a 20% merchant haircut. And if we increase OpEx by 20%, we get an over 2% drop in levered equity IRR down to 6.25%. But more importantly, we want to understand what our DSCR profile looks like. And you would see that lenders would still expect a fairly strong DSCR profile, well above 1 at a 1.23 during the contracted period. And then we are still around 1.8, 1.75 in the merchant tail. So even with the 20% OpEx increase, lenders could still feel fairly confident that they get their money back. Then the very last sensitivity, or better scenario that we're asked to run, is a cash sweep after year 6. So here we essentially just assume that sizing case, but then we apply an accelerated repayment in year 6 onward. So let's first switch over to case 18 to see what our debt sizing case looks like in the base case. And what we expect now, once we flip over to case 21, is that in our cash flow waterfall, the dark blue dividends will disappear after year 6. Our cash on cash yield should be 0 from year 2031 onwards. And we should sweep away the principal as fast as we can. And hopefully that happens within our contracted period. Which means that lenders wouldn't rely as much on the merchant tail in case there wouldn't be a refinancing if we assume a 5-year mini-perm financing structure. So let's flip over to case 21, hit the master macro and see what happens. There we go. You can see how our sweep now ensures a much more accelerated repayment. Our cash on cash yield drops to 0 for 5 years after the mini-perm would end, if we assume a mini-perm financing structure. And you would see right here in the cash flow summary that our debt would actually get fully repaid by year 2035, which is still within our capacity tolling agreement period. And that should be a very comforting scenario output for lenders, because lenders would know that if we assume a 5-year mini-perm, the sweep would basically get them repaid within the fully contracted period. And there wouldn't be any reliance on merchant revenues or the merchant tail, as long as we would require a hard mini-perm after year 5. Then let's move over to our scenarios sheet. And you can see that this sensitivity here also shows in column T that our term loan would be fully repaid by the 31st of December 2035, which is 5 years before our regular debt sizing case, and there's no reliance on the merchant tail. So now we are fully done with our scenarios, and we have a very handy scenario output sheet, which should allow both lending decision makers as well as sponsor decision makers to get an easy overview of all the key outputs from different asset structuring approaches. And we have the ability to look at all the different cases via dropdown to allow decision makers even more visually appealing flexibility so that they can switch between all the cases and see how the cash flow waterfall shakes out, as well as the term loan outstanding, our nameplate capacity maintenance over the full asset life, as well as revenue sources and cash on cash yields over time. And with that, you have made it all the way through the Deal Lab. Seriously, well done. If this course helped you, I would truly appreciate if you could leave a review. Reviews make a big difference in helping others in the industry decide whether this is the right training for them. And if you know a colleague or friend who works with BESS or wants to break into project finance, please feel free to recommend the course to them. Thanks again for your time and commitment, and I'm wishing you all the best as you apply these concepts in your career.